Why not just put everything into SCHD? But SCHD has about 104 different companies within it right now. So, and they don't have REITs in there and some other things that I want to invest in. And plus, I think when you tell people to invest in ETFs, and they're kind of nameless, faceless investments. People don't know what the heck are even in them.
And many times when I follow my emotions, emotional investing many times will lead us down the wrong path. And so I usually will say, I'm emotional. I feel emotion about this. So I'm going to wait. I'm going to see what happens. And I'm going to go off of fact, not how I feel.
Investors, welcome back to another go-round here of Masters of the Market. I'm Ari Gutman, and of course today I'm joined again by Joe from the Average Joe Dividends and Kevin Burgess. We are here talking about dividend investing. Now, just the other week, we were all on together talking about kind of the beginning steps of building a dividend investment portfolio. But now we're going to get a little bit more into the nitty-gritty of what it's actually like to build the dividend investment portfolio. Now, just so everybody here is on the same page, both Kevin and Joe have a net worth over $1 million. So in my eyes, they have certainly made it. And they have been doing very well in regards to dividend investing, seeing a lot of successes. So I'm happy to have them both back on with me. Guys, of course, I want to say thank you again for joining me. Now, last episode of Masters of the Market with the both of you on, we were actually talking about how dividend investing is not going to allow you to really hit these big home runs. And actually, Joe, it was you who mentioned it last time, just before we finished off, that really dividend investing, right, it's not some big home run, and it's really going to be a slow build. I wanted to throw it over to you and kind of ask you what you meant by no big home runs when it comes to dividend investing. I'll pass it over to you.
Yeah, and I also meant that in respect to my investing career. I had no big home runs where I bought Apple back in the 80s or 90s or anything like that. Just it's just been a slow run, really, of just a lot of little wins over time, and just consistency and always investing and having a plan, an investment plan, and sticking to it.
Sure. Hey, Kevin, would you say that's about, spot on for you as well? No big home runs?
Yeah, I would say that, and even to expand that a little bit. I mean, it's and I know I'm pretty sure Joe has a similar story. Neither one of us received a big inheritance, right? So we didn't, get this big pile of money. Matter of fact, I had to pay for my mom's funeral here recently, so it was, we're just not in a place where we got this infusion of cash, and then we're just trying to make it work. We started with nothing basically, and then just built up our portfolio just month after month, paycheck after paycheck, and just stayed consistent and built it up that way. So
Sure.
yeah.
Of course, I want to say it feels like it's an easy one to say. It was probably worth it now, sitting where both of you said. But can you both talk about the kind of the feelings on that slow growth, that slow build? Because I almost feel like, as a fellow dividend investor, and of course, again, the young buck on the chat here, I see so many investors out there investing into growth. And I see a lot of investors who get started and they want to jump right into growth, because a slow build is not necessarily what we're looking for. What kept the both of you level-headed to stay in the game, kind of building block after building block with dividend investing, if there's not going to be this big home run moment?
I guess I'll go first. It's about the income. Now, there are some dividend stocks that do outperform the S&P. Like if you look at like a Home Depot or Lowe's, if you look at them the past 10, 20 years, they have far outperformed the S&P, like a Costco, Apple, Microsoft. Those as well, you could call those growth stocks. But to me, I think if we're dividend investors, we're investing in older companies that are established and not necessarily the traditional growth companies. But there's also so much risk associated with investing in growth. I'll give you kind of an anecdotal example with my girlfriend. Her ex-husband is invested into a company, I'm not going to say what it is, at about $12 a share. And that company right now is at $2 a share. And he's seen his approximately $100,000 go down to about $20,000 in value. To me, that's scary. Because he's got to 6x his money now, just to break even. And if you would have stayed in like an S&P 500 or more state or something more established, there's not going to be that same volatility. So, I mean, you could hit that big home run, but chances are you're going to need about 10 of those growth stocks, and maybe one of them will come through for you, maybe, or maybe none of them do. You don't know.
Yeah, so from my perspective, I would say that there was one thing that I understood when I was younger that really was really helpful, and then one thing I just got lucky, right? So, and I'll talk about both of those. The one thing that I understood was the magic of compounding, and when you think about compounding, compounding is not linear. It's not a line that goes this way. It's actually a curve that does something like this. So for me to stay motivated, those first dividends that I got were really small, right? And so as those got reinvested in different stocks, it began to grow and snowball into what now is a larger portfolio. But I had to be patient because I wanted it to be linear, but it was going to be more of a curve. And so, patience, I guess, was one thing that I understood kind of going into the process. The other thing that I just got lucky on is, the other thing is consistency. And life comes at you, right? I mean, we had 4 kids. We were, I had a successful career. We had sports for kids, and life was busy. But my contributions continued consistently, and regardless of what was going on in my life, those contributions kept hitting that account. And at that time, a lot of them were going into what we call mutual funds. Back then, they're kind of like ETFs, but with less flexibility. So some of the money was going into mutual funds, and so sometimes I would look up and there would be more of a portfolio value, but it was because of consistency. And so I kind of got lucky there, just being consistent every paycheck, donating and not donating, but contributing money to my account. So I would say patience and consistency are the 2 things from my perspective.
Yeah.
I love to toss this one out there. What's at 1 or 2 or perhaps the most common misconception there is about dividend investing that we should right off the bat be aware of? And we can already say, right, probably the slow growth, that's going to be a reality. That should be like front and center for us, especially if you're younger. Just know you're not going to, become Elon Musk by Tuesday. But what are some of the most common misconceptions?
I would say that there's no growth in dividend stocks. There's some of my stocks in my portfolio have performed quite well and exceeded the S&P 500. So there is still some growth in there. You're not going to double every year, or like an Nvidia. Even though Nvidia pays a tiny dividend, I wouldn't really call them a dividend stock. But over time, though, over like 10-year periods, you can see like rapid growth from some dividend-paying companies too. Like I mentioned before, the Lowe's, Home Depot, Costco. So.
Sure. Yeah, I think from my perspective, that's actually, really a great answer. I don't think I can add anything to that. But I think what I would say is that there's also a misconception that when you're dividend investing, you're seeking for the highest yield. When we're looking for dividend investments, we're not necessarily looking for the highest yield out there. We're looking for a combination of yield and growth and good management and that kind of thing. So we're looking for quality businesses, not just businesses that pay a high yielded dividend, right?
Sure.
So I think that's another misconception.
What would in the reality that one of us out here invest into a high yielding dividend stock and we're just getting started? Because I agree. I think that is a misconception, right? That people should be chasing yield. And I also think it's a mistake, one I've also made earlier on in my investing career. And of course, there's a lot of videos out there, I feel like, across YouTube or, even across different articles that we're reading that say, this stock is 9% dividend yield, buy it now because this yield, right, is off the charts. That type of, lingo I think really attracts people to the stocks. But what could happen? And has a dividend cut? Have you experienced a dividend cut, and how has it? Want to say what's the impact of that yield cut?
Yeah, for my portfolio, if a stock cuts its dividend, they are cut out of my portfolio. And recently I had one where I cut them prior to them cutting their portfolio. There's some chatter about it. And it was medical properties, MPW, and people writing articles saying that I think there's their second biggest tenant was in danger of not paying their lease. And so I heard that from multiple sources, and I cut out of there. And that stock dropped, like it went like in half. They cut their dividend in half like a week later, and then it went down to like from $10 to $5. It was really extreme what happened. So I got out of there just in time. So
Would you advise jumping in like now? Like, okay, so the yield was cut. Is there a future now in getting invested into such a stock now that the yield's cut and maybe we have some more upside to come in the future? Or is this like one that we're just going to avoid now at all costs?
This is just me, my perspective. I cut them out, and I'm looking more for companies that have shown me, like in the past, between 5 and 7 years, that they've doubled their dividend for me. Something like a McDonald's, you look back and it takes them like at less than 10 years to double their dividend. And those are the companies I want to fill up my portfolio with, not the ones that cut it and maybe present a potential bargain, and the potential of raising their dividend back up. I want a consistent company that's not in trouble. They navigate the waters perfectly, and I feel confident in them.
Sure. I'd say it's like the ultimate bait and switch. Get invested and they've hooked you and now they got the dividend. I'll pass it
Yeah.
over to Kevin.
Yeah, one of the things that I struggle with, on a daily basis is, stocks that have been hammered, right? And so, let's take an Intel, for example. So they not only got hammered before they cut their dividend, they got hammered after they cut their dividend because they were, the shareholders felt kind of misled, right? In that whole debacle. And so, at some point, a stock, even when it's in trouble, even when its dividend is in trouble, might be a good investment, right? Because it was I willing to pay $1 a share for Intel? Absolutely, right? I mean, so at what point does it make sense, even though the company's struggling, the dividend's been cut, that it makes sense to buy into those stocks? And that's a struggle that we all have as investors, right? Where is that sweet spot, and where do we buy into that? So and so I think personally, I think there's room for a couple of stocks in your portfolio where you think there's a turnaround story. I mean, IBM was one for me, right? I mean, they didn't cut their dividend, but they were really beat down. They had several tries at revamping their strategy. So a few years ago, I bought into IBM, and it has been a great investment for me ever since. But I mean, still, it's a higher yielding dividend stock, but I'm not sure if that's the best example of this. But at the end of the day, I think there's room for, I don't want to call it gambling, but it's really about, hey, this company is really beat down. These dividends have been cut, but they are doing the right thing, right? By getting their cash flow in line. And it's okay to kind of buy into something like that. When you believe in the management, you believe in the strategy, all those things we talked about last week, then maybe it's worthwhile, but only we can make that call for our own portfolios. So
Sure.
it's a tough call, and every day that we do research, we struggle with that, or at least I do.
Sure. I want to ask a follow-up question there for you, Kevin. Are there any indicators that we could perhaps find or seek out for these turnaround type of plays? I'm curious, like if we take like a Tyson Foods right now, of course there's a lot of, macro things going on here for Tyson to be so beaten down, but you also have a company that the management team, like, I mean, do I even have to say anything more about the management team? And the legal issues they got themselves into not too long ago. Likewise with Purdue. But are there any indicators for looking for turnaround stocks or signals that you have at least?
So this is where the history and the numbers really don't come into play that much, right? Because something has happened, like, with Tyson. Actually, that whole sector is beat down. I mean, Tyson, Hormel, ConAgra, I mean, all of that sector is just really under pressure. And I guess rightfully so. But when I look at that, I look for, first of all, is the sector being beat down, and is it not necessarily the company's fault? Has their strategy changed? Has their outlook changed? Or is it just that the market is unfavorable toward that sector? And if that's the case, it gives me a lot of comfort, right? So that's one thing I would look at. The other thing is, even if it's the company's issue, do I believe in their strategy? I really want to spend a lot of time with their strategy. And sometimes that strategy changes, right? Intel had a change in strategy. Tyson, I don't know. I mean, their strategy is hard to change because it's about producing, consumable food for us. And so, they can go into these plant-based things and stuff, but I don't think that moves the needle in all of this. So the challenge, with Tyson is very real. I used to own Tyson. And about a year and a half ago, I sold off because, and this is kind of interesting, maybe it was interesting for me, so I'll share it. I listened to this was about a year and a half ago, maybe it's 2 years ago. I listened to their Investor Day program and all of what they were talking about in terms of growth for them. And I was like, I don't believe that. I don't think that's going to happen, right? It just didn't make sense to me, and so because of that, and I don't move quickly, right? It's not like I listened to that and the next day I sold everything off. But over the next month or 2 months, I just got to the place where I was like, I've got better places for this money. So I would say that from that perspective, it's about strategy, it's about management, and it's about understanding their industry and whether they're going to be able to carry that out.
Do you recall what was specifically said that was your red flag moment?
Oh man, when you get old, you kind of lose some of your short-term memory. But I don't, I don't remember specifically what was said, but I do know that it was around their growth prospects. So when I was listening to how are we going to grow this business, it just didn't ring true to me that was going to be able to happen. And I could have been wrong as well, right? It's not like, I made this great call. It's like, you make those calls every day. But sometimes you win, sometimes you lose, right? Just so happened I won on that one.
So I'll go in this direction here. Like I said, like we kicked off this call and the whole series, the reason why Joe and Kevin are on with me now is because their net worth is way over $1 million. And they've seen a lot of success in dividend investing. So now we're about to put both of them on the hot seat here and get a little bit into the secret sauce of their strategic process and picking some dividend stocks for their portfolio. And so now I'm curious to know from the eyes at the top, if you will, the masters here of the market for our series, what is your strategic process? And Kevin, I know you speak a lot about the intersections. But if you can even go a little bit deeper there, how like you just start off from the get-go and where you would look to, what you would be looking into, and we'll go a little bit more in depth on both of your processes.
Yeah, so I'll go ahead and kick this one off. So I talk about the intersections in mind, but to kind of think about how do we kind of get into the process, right? I mean, one of the things that people say about dividend investing is that we're limiting ourselves, right? We're only limiting our investments to dividend paying companies, and therefore our returns are going to be less over time. And what I would say to that, and what I've experienced, is that there are more than 4,000 companies who pay dividends. And to be honest with you, I've got a portfolio of 34 companies. So out of that over 4,000 companies, I've picked 34. Now, granted, there could be in the remaining 6,000 companies that offer shares on the marketplace, there's probably some growth stocks that would work well for me. But I've got plenty of stocks to choose from, right? In my 4,500 dividend paying stocks. So, so the first part of the process is, where do my ideas come from? What stocks do I research? I can't physically research 4,500 dividend paying stocks. It's just there's not enough time in the day for me to do that. So I had to narrow that down. And so, listening to videos and reading articles and that kind of thing helps kind of bring stocks to my attention. And once they come to my attention, then I had this intersection that I talk about, and it's the intersection of growth investing. I'm sorry, dividend growth investing, which is different from growth investing. So it's the intersection of dividend growth investing, value investing, and management execution and strategy. So that'd be the third street in that intersection. So when I look for that, I'm looking at the past, right? So I'm looking for good financials, and I look at their balance sheet. I look at their income statement. I look at their statement of cash flows. I look for companies with decent payout ratios, companies that are investing in their business, that are not necessarily paying all of their money out in dividends. I want a healthy business. So, that's kind of part number one, is around the financials. Part number two is about capital allocation. How much of their dividend are they paying out, and what are they investing back in the business? So those are the two. Then when I hit the third one, it's about valuation. And we talked about that last week. I just look for, am I getting a decent deal? And it doesn't have to be cheap. It just has to be fair, right? A fair price. Then I get into, so those are those two intersections, right? I'm looking for dividend growth, and I'm looking for value. And so then the third intersection has two pillars to it. One is, what is the strategy? What is their product mix? Are they a company that adds value to the world, right? Do they bring something to the table that people want? And so that's the strategy piece of it. And then I look at the management team and I say, is this management team the management team that can really bring this to pass? So those are my three intersections. I'm looking at value, which has to do with valuation. I'm looking at dividend growth, which has to do with financials and capital allocation. And then I'm looking at strategy and execution, which so those are my five pillars, kind of described in terms of an intersection and a road. So
Well done. I don't have much to add to that, Kevin. Just I could even just provide even more simple like criteria. You could look around your home and just kind of maybe find some products that you use, and a lot of them could be your Procter and Gamble, things like that. Just one example. I'm not saying you should buy Procter and Gamble today, but just they've been a growing company, and just take a look at the company's moat too. Do you how do they fare against their competition? Do you think they'll be around 10, 20, 30 years from now? Like McDonald's, I predict the McDonald's that are in business around me are going to still be in business around me 20, 30 years from now. Same with like a Starbucks, a Home Depot, Coke and Pepsi, things like that. Just I don't think they're going anywhere soon. So I think you get if you get 20 of those and really do your research and vet them, like Kevin said, I think you're going to be doing okay.
maybe just to add one thing onto that is Joe makes a great point, is that, when you've been doing this as long as we have, sometimes it sounds complicated, but we started very simple. And I would just say that, get ready. If you're new to dividend investing, if you're new to investing in general, get ready to learn something new every day. And so every day you're learning something new. And over a period of 20 years, you're going to have learned a lot. And so you're going to be able to share a lot because you've experienced a lot, you've learned a lot, and it's going to sound complicated, but it's really not. It's learned day after day. And you learn, hopefully you learn in small doses so that if it goes wrong, you're able to correct it. But every day you're learning something new. So that's a great point.
That's incredibly insightful. I mean, really, it's because I feel like as investors just starting out, right? It's like you think you have to have everything together from the get-go. And therefore, I actually think that limits people from investing, or perhaps prevents people from getting started investing. And one thing that I know for myself as an investor, and what I've really learned over the years investing, was the necessity to understand a balance sheet, at least like bare bones balance sheet. Now, last week we were talking a lot about right? Like personal finance and being able to budget and manage your money so that you can get invested. But I want to go one step further here, because at least from where I stand today as an investor, something that I take to heart is that every company I invest into, I ask myself a very easy question. Aside from if I understand the business, am I able to look at their balance sheet and agree or align with it, right? And if I'm looking at a balance sheet, because the way that I live my life today, right, is debt free, and I don't carry any debt, and so therefore, if a company is carrying debt, that's also alarming to me. And I want to pass this over to both of you and ask, what's an efficient way to simply navigate through a balance sheet without stressing ourselves out? What are some of the things that we should be looking for? Some of the metrics that we should look for on these company balance sheets, just to make sure they're squeaky clean.
I don't know if I must go first on this one. Yeah, I don't know if we could cover this in just a quick question or pass through, but yeah, I just make sure that there isn't super high debt with the company, and that's subjective. You could take a look at a company like Verizon, and you could say they have extremely high debt, and it could be unmanageable. I think when it gets to the point where it's unmanageable for the company, and maybe their payout ratio is really soaring high, that's when you could maybe, some red flags will come about. I mean, that's a simple way of looking at it, but that's probably the quickest way to hit that. I don't know, Kevin, if you have more to add to that.
And that's a tough question. And I think maybe just a couple of points would be one of the things I look for is the level of net debt that a company has. But I probably don't go as far to an extreme to that, because let's kind of boil this down a little bit. A company really has two sources of funds that it can invest in its business, right? It can invest from equity, which is shareholders like us. We're buying the shares, and or at least in the IPO, we bought the shares. And so that money went into the company. And then there's also the ability for them to borrow money to so they put both of those together. That becomes the funds that they invest. And so if they're going to have a project that they're going to invest, let's say they're going to invest $1 million in a piece of equipment that's going to make them twice as efficient. And let's say that payback is 1 year. So that means that every year they're going to get $1 million, right? And if they borrow the money to get that, and let's say they borrowed it at 10%, they're going to pay $100,000 the first year for the debt service, right? Because they borrowed $1 million, 10% interest, they're paying out $100,000. Well, if they got a 1 year payback on that equipment, they got a value of $1 million coming back, right? So if they had gone out and said, hey, we're going to issue more shares, then now we've got more shareholders diluting the earnings of the company and sharing in everything. Whereas, the 900,000 difference, the $1 million minus the 100,000 in interest, that 900,000 gets allocated among existing shareholders. So I think there is a place for debt in a business, but it needs to be managed well. And so I look at, and some people look at debt to equity. There's some shenanigans that can go on there. Like, for instance, when share buybacks are done, it actually reduces equity. So it's kind of hard to look at debt to equity from my perspective. I look at a metric called return on invested capital. So what that does for me, and that kind of incorporates or encapsulates the balance sheet, right? So I look at how much return do we get on both the debt and the equity that's in the business. So together, what kind of return does the company make on the money that it's investing? If that's a high number, let's say it's above, I don't know, 15%, that's a pretty good return on invested capital, right? And there's some that, like, I think if my memory's right, Microsoft's like, 35 or 50 or something like that, right? So, I look at return on invested capital. I look at my mind just went blank, staring at a camera. But I look at net debt. I look at the interest coverage ratio is another one that I look at, where And basically, for in simple terms, it says how much money is the company making, and how quickly or how many years would it take for them to cover the interest that's on their income statement. So I think all of that kind of works together: debt and the interest coverage ratio, return on invested capital. Those are some of the metrics that I look at when I'm looking at a balance sheet. We're heading into the place of nerddom, right? I mean, this is really like nerdy kind of stuff, but it's who I am. I'm a nerd. So what can I say? It's kind of fun.
No, look, I think it goes hand in hand with when we invest into a company, what we're really doing is taking part ownership now of the company. So are we able to put the cap, if you will, on of the CEO or the CFO? Are we willing to, step up? I always like to say, like, be the CEO of your own life or CFO of your own life. And if you don't know at least the bare bones about a balance sheet, or, how to work your way across or through that balance sheet, perhaps you should take a step back for a brief moment and start to look at your own personal finances, understand your budget and your balance sheet for yourself, for your own life. Now apply that to the company. But Joe mentioned something that was interesting. I'm listening into everything that's being said, and so now you both got to be careful, right, with what's said. But Joe mentioned in his reply this thing we call a payout ratio. Now, this is an interesting one for me, because how in the world do we know how high is too high for a payout ratio? When does it get dangerous? And when should our red flag go up as a dividend investor in regards to that payout ratio?
That's a good question. I think it's subjective as well. I've heard the sweet spot is between 40 and 60%. Some people say 70% is okay, but I think if you're creeping up above 70, I think it's getting dangerous, where that dividend is consuming so much that they're unable to, reinvest back into the company or even pay debts or whatever they have going on. So you don't want to, probably above 70. 70 is where I feel comfortable, at least personally.
Yeah, I think that's good. I think my answer usually is it depends, right? And so it depends on what business the company's in. And let me take you to an extreme here. And the extreme would be the business development companies, what we affectionately call BDCs, right? Main Street Capital would be an example of that. Ares Capital. So these guys are, due to their tax status, are required to pay out 90% of their AO, or their adjusted cash flows, right? So their payout ratios are going to be much higher. They're going to, they can be anywhere from 80 to even 95% of their cash flow. So I think it depends, and I do invest in one of those BDCs, and what it gives me is it gives me yield and the ability for some capital appreciation. It's not a huge part of my portfolio, but it does have a place, even though it's probably 85, 90% payout ratio. So, but then there's other companies that, have very, very low payout ratios. And the companies that, so I guess the way I look at it is the companies that have a tremendous growth potential, we want them to have a low payout ratio, because that payout ratio means they're giving us some money through dividends, but they're also converting a lot of cash into investments for the future, right? Companies like utilities, BDCs, limited partnerships, right? Those guys would have higher payout ratios just because that's the nature of their business. That's what we invest in them for, is current income. So I think it depends. It depends on what you're after, and I wouldn't count out a high payout ratio, but I would want to understand why it's there before I would invest in the company.
Sure. We'll jump into this one. Fact or myth? The size of a dividend investment portfolio matters, or is it just diversification?
I'll handle this one. So I think the longer I do this, I've been reducing some of the positions. So I'm still over 60, but I would like to get to 50. I think that would be the sweet spot. But most of my dividend, my position in dividend investing is in SCHD, and that's where most of my money goes into. I've had people comment on my videos, and it's a valid point. Why not just put everything into SCHD? But SCHD has about, I think, 104 different companies within it right now. So, and they don't have REITs in there and some other things that I want to invest in. So the criteria they use isn't, I agree with most of it, but it leaves out some companies I like to invest in. And plus, I think when you tell people to invest in into ETFs, and they're kind of nameless, faceless investments. People don't know what the heck are even in them unless they go to the website, Charles Schwab's website, and see what's actually within and what their top investment is within SCHD or whatever it is. And I think just investing in individual stocks, I think creates more excitement, and people are more willing to follow it and actually invest into it. More consistently. It's the people I'm running into that I talk to now. So,
Sure. Kevin.
Yeah. I think, when I think of diversification, I think that came from Peter Lynch, right? From back in the 90s, 1990s. And I think that if you went back and looked at his portfolio, he had a ton of holdings. He didn't have 10, he had like 100 and 200 or whatever he had. But so I think the point is well taken, and that is, are you buying stocks to buy stocks, or are you buying stocks that you can understand and that you believe in their future growth, right? So I think that is very important. When I think of diversification, I would say to anybody who's maybe looking to get into dividend growth investing or has been in it for a while, diversification, I think, is important. But I will tell you that if you invest in an ETF, you are automatically diversified because it is a pool of stocks. So if you say, hey, I'm going to invest in an ETF and I'm going to take some amount of money and pick one or two stocks, don't worry about that because you're diversified in your ETF. And if you're just taking a sliver of your portfolio and investing in two different stocks, that's not a problem. You're not, causing yourself any problems with that. I guess my thoughts on SCHD, I think it's a great ETF. I don't own SCHD, but what I use it for is a benchmark against my portfolio. So I will take my portfolio and I will take SCHD and I will compare them. And and I happen to be beating SCHD, and I also compare it against the S&P 500, but not as much as I do because my purpose is income, right? So I'm looking to the same purpose my portfolio has, SCHD has. I think that's a great comparison. And so I look to see how well am I doing compared to the ETF. If I can't beat SCHD, why don't I just buy SCHD, right? That's kind of the way I look at it.
Sure. Joe, are you beating SCHD as well?
I'll have to take a look and see. I do have it split out between my ETFs and then my dividend portfolio. I think it depends. I'll have to look and see where I'm at right now. But I think most of my portfolio is beating it, or a lot of them, like the Apple, Microsoft, things like that in there, NVIDIA especially.
You're also
So
invested directly in it. So I guess it's a
yeah,
lot of your portfolio. You're
Yeah.
running along with it. I guess investors, we all know where we're going after this video. Over to check out these two channels here from Joe and Kevin as they're beating SCHD, which is, I think, the investors' craved favorite, at least in the dividend investment world. I want to go on this next question, jumping into asset allocation. And when you start to profit, perhaps a decent amount, and you start to trim and reallocate capital, how do we navigate through all that? Where do we begin? How do we know when to start to trim and allocate capital elsewhere?
Whenever I see maybe something's underperforming, and not just because it could be in a sector that could be underperforming, but not because of that. But if I have something that's within a sector and there's other things doing better, or I just have a better place to put my money. But I don't do this just quickly. I think, Kevin, you mentioned you waited a while before selling Tyson. I will kind of wait and watch, and I'll put it on a list like, okay, this stock may not be doing what I was expecting it to do, or there could be a dividend cut, or whatever there is. Something has changed. The metric has changed, and then I will try to find something within my own portfolio uh, that makes better sense. Maybe has a higher growth potential. Maybe could be growing their dividend more rapidly, or maybe even pays a better dividend today. So
Yeah, that's almost exactly what I do. Is I don't move fast. I don't buy fast, and I don't sell fast. Um, One of the things that I look at is what I consider the valuation of the company. So, as you know, a stock will go in favor and what go, away above what I believe the fair value is of the company, and then it'll come back out of favor, below. So, throughout its career, it's going to have this motion. If you think of the value of a company being a straight line, it's going to be above and below that throughout its career. So, I look at, from a valuation perspective, if it's really high, then I look to sell. If it's really low, I look to buy. And if it's somewhere in the middle and I have some funds, then I may buy some. But I typically will look at the valuation, and again, don't go very fast into it. But uh, the I actually, in the one of the tools that I used, I mentioned last week, is my portfolio. And in that portfolio, it actually shows the valuation of these stocks, and it takes the current share price divided by the valuation, or vice versa. And so if the company is below one, then it's going to be undervalued, and if it's above one, it's going to be overvalued. So I have a sheet set up that actually sorts that and brings all of the lower value stocks to the top for me to take a look at on, whenever I go in, usually on a daily basis, but at least on a weekly basis to see what's happening.
Sure. Sure. Now
and
we
if you
started this episode here, Masters of the Market, with sharing that there's going to be, not going to be any big home runs, and it's a slow build. Now Kevin just alluded to it once again here, right? Not to move fast. Joe, I also believe you just shared, don't move fast. You move very slowly and methodically as you go about this dividend investing process. How do you both move slower? How have you trained yourself to not have a trigger finger on the buy button? Is there any tips, tricks, anything that you can give us insight wise?
Yeah, I'll go quickly. Remember when COVID was happening, things were dropping quite rapidly, and I thought, okay, this is the bottom of the market. I had some money in the sidelines, and I kept on putting it in and putting it in, and of course, what happened? I put $1,000 in. Market kept on dropping. Another thousand, another thousand, and pretty soon I was out. I was out of cash after a while because the market kept on going. I forget how long it took for it to hit the rock bottom, and I was like, and of course, we can't time the market, know when the bottom is going to happen, but I've just tried to chase it, try to deploy everything as quick as possible. And but I always run out of money before reaching the bottom. At least that's been my experience.
Yeah, no, that's a great question. I think for me, I think it has to do with the school of hard knocks, right? So sometimes, we sell too quickly. We get scared, right? It's these emotions we've talked about before. When I have that emotion where there's fear, then, I'm going to make a rash decision. And many times when I follow my emotions, emotional investing many times will lead us down the wrong path. And so I usually will say, I'm emotional. I feel emotion about this. So I'm going to wait. I'm going to see what happens. And I'm going to go off of fact, not how I feel. And it usually takes time, right, for data to come out, for companies to turn themselves around, or whatever. So I think it just comes from experience. You know, you're gonna have these fears, and they will never go away. Trust me, even after I've been doing this long, I still have emotion around certain stocks, and I will tell myself I need to sell them, but then I also think back to all the mistakes that I made, and I go, I'm not gonna sell them yet, right? I'm not gonna do that at this point. I'm gonna be patient, and I'm gonna see what happens.
Sure. Sure. So it's been said before, at least there was a study that was conducted where I believe they took a monkey and they gave the monkey a dart, and the monkey threw it at the dartboard and it landed on a stock. And apparently this monkey, right, is like the Nostradamus that we all need, picking the best stock that outperformed all the others. My question here, right, to Kevin's response is is there any chance to develop it, kind of like a gut feel when we're investing? Or is it really just we need to back away from emotions? Because I feel like sometimes in a lot of aspects of life, at least, gut feelings actually guide us in the right direction. But is it with investing that we should just totally stray away and remain with logic?
I think from my perspective, we're gonna have gut feel. I mean, that's who we are. We're human beings, right? And so, what we're trying to do is to trim the edge off of that gut feel, right? It's not that I don't go by gut feel, because I mean, there's some stocks in my portfolio I just like them. It's not necessarily because they have this logical process, but I just like having them in there. And so there's this gut feel, right, that we have. What we want to do is we want to trim that, and we want to keep that gut feel from making rash decisions. We just want to trim that emotion out of the process. That's the way I would describe it.
Sure. Anything to add,
Yeah.
Joe?
I I think you have to have a written strategy, and you have to write that strategy before there's a big market dip. And because I think what happens is a lot of people will get emotional during that market dip and they'll say, what I'm doing is wrong. It's not working. All my stocks are dropping. So I better do something. I better get out. And that's the worst time to do it. You just have to stick by your guns, and you have to keep putting money in when it feels the worst, because you could see that money. It doesn't really evaporate, but I've seen before. I put $1,000 into my account, and literally the next day or two, with the market dropping, that it's dropped by over $1,000. I'm like,
Mm.
I could have spent $1,000 on something. That's your emotions thinking that I could have bought something really nice for $1,000, but you're not really thinking logically. Oh, I just bought something on sale. Of course, it went down even further, but it's chances if you invested it wisely, it's going to go up even more. So it's a very hard to trick our lizard brains to do the right thing when the bullets are flying and the market's dropping. I felt that even with COVID, where my net worth was dropping, sometimes like daily in the six figures. I was thinking, I would take a walk around the neighborhood, like, God, I gotta do something. I gotta do something. Like, do I sell? I just stop the bleeding. But you can't do that. You have to just stick to your strategy. And in those bad times, you have to be investing even more. I mean, you just got to keep at it. That's when I think millionaires are made, is in those times too, when you get emotional. But you got to stick by that written strategy. That's the key.
Wow, wow.
Yeah, I totally agree with that, and I have a written strategy as well for not just my stock investments, but my real estate investments as well. And so I think that's a critical point. That's a great point, Joe.
Likewise, I love that. Like, write your strategy down. I was going to ask, is there
Yeah.
any way we can hear firsthand what either your written strategies or your right, like your
Yeah, I could.
go-to statement
Yeah.
is?
I sometimes go over it in my videos. I just have some simple like bullet points of things, like whether a strategy of to get rid of a stock or to other things. But the more general one, I do have a Word doc I could probably show you. It's pretty basic, just bullet points. Don't panic and keep investing, and stick with the strategy, because if the strategy was good before these market dips, I guarantee it's going to be good after. So you're just getting emotional, and you just gotta. But it's tough though when you're in it, and it can be tough. And who knows, we could be in one of those. Remember the lost decade? I predict we could maybe have one of those happen again soon, where returns are flat for minus dividends possibly for another 5, 10 years. Who knows?
Mhm.
Because we just don't know. But
Yeah, I think when I think of my written strategy, I look at my portfolio overall, and each of my investments in general have a purpose. So I think the first thing that you want to do if you're going to write your strategy down is to focus on what is its purpose. Because like for instance, I have two. We'll just stay with my dividend portfolio, and I have two pieces of that, or at least I think of them as two different pieces. One is producing current income, and one is producing growth for the future. And so I have different purposes for each of those portfolios, which then drives me into criteria that I look for. So in my income producing portfolio, I'm looking for a yield that's above 4%, but I also cap it at 7.5. And why do I cap it at 7.5? It's because I don't want to chase yield. I want to look for companies who are solid, right? So, but I had to put that down on a piece of paper and say, yes, this makes sense to me for my portfolio to achieve the purpose that I have it there for. So
Sure.
there's a ton of those little things.
No, it's incredibly insightful. I mean, it's really just an investor's mission statement. Should we have that written down before we get started investing, or is this something that's developed along the way?
My
I think
response
so.
is it's both.
Yeah, I would start with one, but yeah, you just have to know why you're invested in something, because when something does go down, I mentioned in the last video that you just have to be all in on it, even though let's say it goes down 10, 20%, and indexes can do that all the time. You just have to know that, the S&P historically has produced, around 10% per year on average returns. That's not what you get every year, but just knowing that to me gives me enough confidence to stick with it and invest in it through thick and thin. And I think if you don't have that same philosophy with your investments, whether it be an individual stock, you may not want to have in your portfolio then.
Sure. I just have this vision of Joe walking around the neighborhood like sweating,
Well, I was.
so,
Oh, yeah.
and then he
My
pulls up
net
his
worth
mission
was down
statement.
hundreds of thousands of dollars. I was like, what do I do? And the answer was nothing, just keep investing.
He's
And it
sweating.
worked out. Oh yeah, it just, like I said, it's hard. Kevin, it's when you're going through those downturns and seeing just everything just drop. It's like, oh my God. Yeah, but you gotta push it out and just concentrate on something else, earn more money and put it to work for you, invest even more during those times, even when it feels like it's the worst time ever. Because all that market is doing is dropping. Why would I put money in there? Well, that's the best time.
I'll cut to the brass tacks, right at a direct question. Have either of you ever succumbed to those fear-related emotional, I guess, withdrawals from the market and pulled your money? And how much did you lose?
I did. I didn't, well, it was through a work 401k. What I did was the stock portion I had, I converted it to bonds back in 2008, 2009. And it wasn't for another, I was still contributing to my 401k with my work and everything, but it was going into bonds and it had been converted to bonds. So I thought that was safety. It was just out of ignorance back then because I wanted to stop the bleeding. And so for about 3 years, I was invested so conservatively, I missed out. Who knows on gains? It could be six figure amounts that I lost in gains. And I finally came to my senses and put everything mostly to like a VTSAX kind of investment, total stock market index. So yeah, so don't, yeah, if you're younger, I just recommend don't even put bonds in there. I would just go 100% like VOO, VTSAX, just and ride it no matter what the market's doing. So
You heard it here first, folks.
just my
Kevin,
opinion.
the pressure's on. Have you ever succumbed to the emotions and sold?
Yeah, I did. And so first of all, I've been through three of these big ones, right? And so in 2000, I didn't have a lot to invest, and so it wasn't as big of a deal. In 2008, 2009, or when that really began to drop, I stayed the course, right? I did not veer from that. However, moving into COVID, I mean, this was before COVID. This was back during the political elections, and I actually pulled some funds back I didn't sell out everything, but I did set up some cash reserves, and that turned out to be a bad decision because the stock market really continued to grow even after the election, and so it just helped me to learn. Remember what I said, we're learning every day, right? So it helped me to learn that it has nothing to do with who's in political office, right? It has everything to do with the economy and what's going on as to whether things are going to work. And so fortunately, although I missed out on some gains from, let's say, 20 to or 19 to 20, I was able to capture some gains during the COVID piece. So I never have gone back to calculate how I did there. I probably broke even, but who knows? I may have lost some money in that process. But and what I will say about this is that the bigger your portfolio gets, the more emotion that you have. And so remember in 2000, I was like, I don't have much in there anyway, so it doesn't really matter, right? And then, even in 2008, 2009, it wasn't as big a deal. But, when the market can move 1% and I'm losing or gaining $13,000 a day, it moves, it's an emotional thing. It's a lot of money. So, I would say that the time you have to really be on your guard from your emotions is when your portfolio gets bigger, because the bigger it is, the more painful it is and the more emotional it is. So just be ready for that as your portfolio grows.
Great point.
Interesting
Yeah.
perspective. Go ahead, Joe.
I was just agreeing with Kevin. Yeah, once your portfolio gets above six figures and you see those swings, it gets harder and harder.
Yeah.
It's such an interesting perspective to gain. And I think just from being a dividend investor, right, the vast majority actually of my audience out there is on the elder age there, right? Like elder 30s, 40s, 50s, and then closer to retirement versus the younger, right, the 20 somethings or earlier 30s, which I think makes sense. But this next question is for the elders out there who are looking to get started. Is there ever such thing as it's just too late?
I don't think so. Even if you get to no debt, I think that's great, especially with they say what is like 40 to 50% of people can't even come up with $400 for an expense. I think if you can pay off your consumer debt and you can get just a nice, a nest egg, say a little emergency fund of $5,000 and start contributing, and starts a 401k, even if it's late, even if it's at 60 years old, I think you're ahead of a lot of people. I've heard people who still had student loans into their 50s and 60s, and to me that's scary. And so I don't think it's too late. I don't, it may be too late to retire early, but I don't think it's ever too late to fix your financial situation. And even paying off debt, that is such a stress reliever. And I think because I've been in debt before. I had, well, my ex-wife had student loans. It wasn't too much. It was under $15,000. We had some consumer debt, but I remember just living through that. It was so stressful. You really can't sleep well at night. And just when you're debt free, it's a totally different ball game, especially when you have a little bit of a cushion in there too, and you can absorb any emergency that comes along. And I don't think it doesn't take 10 years to build that up. So I don't think it's ever too late.
Yeah, I would agree with that wholeheartedly. I mean, it's never too late. I mean, if I think about someone maybe who's getting closer to retirement and they're saying, man, I am nervous because I've not done any savings, I've not done any investing, getting closer to my retirement years and I'm nervous. I would say stop being nervous, get your budget in order, figure out how much you can invest and get started, because it's going to be freeing for you as you begin to get your first dividends, and you're going to say, wow, even if it's $1, right? It's like, wow, that's $1 I didn't have, 3 months ago. Right. And then all of a sudden that dollar turns into $2, and then that $2 turns into $4. So over time, as you continue to invest, in these companies, then you're gonna, maybe you won't have $100,000 dividend portfolio at the end of the day, but who cares? It's more than you had, and it's more than you would have had. So never ever too late to get started.
Such an optimistic message. I feel like it is just never too late, which is actually now like astonishing for me, because I have actually had a couple of buddies of mine, right, who have actually already shared it's a little too late, isn't it? And I'm like, you're not even 30, right? Like,
Wow.
it's too late. It's the perfect time to get started. Get started now. Time is of the essence. Now I want to go with another fact or myth question here for the both of you. And the fact or myth question is, do monthly dividends matter more than quarterly?
I'm gonna say no. And I've seen a lot of videos of people who kind of tout them, and to me, I think it really doesn't matter. To me, you could make an argument that you can reinvest your dividends quicker, but that's to me is, I don't want to say it's a gimmick, but uh, I right now I have just two monthly payers, and if they were quarterly payers, I'd still have them. You have to choose that stock not based on their payment frequency. It has to be based on all the factors that Kevin and I had mentioned before. So that's maybe the cherry on top, possibly, but it can't be the deciding factor, or not even close to it.
Sure.
Yeah, I know some people who love monthly dividend payers, and I actually have some. I've got, O, which is Realty Income, and I've got I mentioned it earlier, Main Street Capital Corp, which is a monthly payer. But again, I have those not because they pay monthly, but they just happen to pay monthly, right? So I bought them for other reasons, just like Joe said. So I would say no. There's no value to me. Now, if you look at it mathematically, yes, there is a very minor improvement because of being able to reinvest more frequently, but it's such a sliver. It's inconsequential. So it doesn't move the needle for me, and so I therefore don't think about it. I also have a company that pays very small dividend on a quarterly basis. And then at the end of the year, it pays out a bigger dividend as a special dividend. And so, I have that, even though it doesn't pay much quarterly, it pays out a lot on an annual basis. So I think you can go both ways with that. Uh, and the name of that stock is CME. It's the Chicago Mercantile Exchange, CME. And I just like their the way they run their business. So that's kind of the way I look at it, is that it really doesn't matter to me. And I know some people, and I'm probably talking way too much, but I know some people who will take and try to get an equal amount in each month of the quarter. And that's great if that's what keeps them engaged and keeps them in the process, right, of investing and researching. Then if that's the purpose of it, that's great. I don't think mathematically it really does anything for me personally, because I can average out what I'm going to pull out of my dividends. So it doesn't matter if it comes in month 1 or month 3 of the quarter for me. I just average it out. So
Yeah, with my dividends, the first and second month of the quarter pays the least, and then the third, your March, June, September, December always pays the most if you have a whole bunch of dividend paying stocks. And I do the average. I'll take the quarter, I'll add them up for the quarter divided by 3, come up with that monthly, the average monthly rate. So yeah.
Sure. We'll round up with one last final question, always on a high note to end these Masters of the Market chats. I'd want both of you to think back to your most successful investment. What company was it? How much did you actually return from that investment? Are you still invested into it? What would I want to say your best success when it comes to investing into a dividend stock since I guess you've started?
I will go with NVIDIA. I don't have the exact numbers, but it wasn't a whole bunch of money. I put in like 1,000, and it's like worth 3,000 now. So it's only tripled. So, but of course it pays such a tiny dividend. You really can't even call it a dividend stock. It's a growth stock. So, but I've had some success with like AbbVie and some other things too, or like Exxon. I bought Exxon back in, I think it was March of 2020. It was down to like $40 a share. So that one's over doubled. It's over $100 now. So it's over doubled. Exxon's been good to me too, where it was like a $1,000 or maybe like $750 investment, and it's triple or doubled. So those are probably my biggest ones. The other ones I've just been, between 5 and 25% gains, and just over a short period of time. But then I've had some that I've lost too. So anyway.
Sure. Yeah, I think from my perspective, and remember early on, I was investing more in mutual funds. So there was not, I don't have stocks from 20 years ago, right? I did invest in stocks along the way, but I don't remember a lot of them. So I think maybe I'll just go with kind of where I am today. Maybe what's my best stock at the moment, and it is currently EOG Resources, which has it's almost doubled in value. I've owned it for probably 2 years now, so that's been a really good stock for me, and I do plan to keep it for the long term. I think it's got a good strategy, so maybe I will share with that one because my brain won't go back far enough. And I've sold stocks within the last year that I've forgotten about, AbbVie being one of those. I sold out of AbbVie because it got overvalued from my perspective a lot. So I went ahead and sold out. And I probably doubled on that one as well, but I just don't recall. I'd have to go back and look. Since this is like hot seat kind of stuff, some of those details are escaping me.
All good. We'll let you off the hook. Investors, I want to thank you again for joining us on another round here of Masters of the Market. This is episode 2 out of 3 that we have with Kevin Burgess and Average Joe Dividends here with us again. 2 net worth individuals over $1 million who have seen a lot of success in dividend investing. My recommendation is jump over to their channels and start to actually invest alongside with them by realizing all the economic insights that they divvy out on their channels, the stock insights that they share on their channels. It really will set you up for success. Definitely recommend jumping over there to their channels after the series here. And of course, we are looking forward to next week. We're going to get even deeper into dividend investing, some of the ins and the outs here, more tax related questions, and of course, the ultimate related questions to when to sell dividend stocks. When are they like a red light, sell it, get rid of it type of stock that you're not going to want to continue to hold in your portfolio? So more dividend investment related questions to come. Joe, Kevin, thank you so much for joining me again. And investors, until the next time, we will see you all there.